Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host on the Five Talents Commercial Podcast. And we're super excited today to have an amazing guest, Mr. Ryan Smith, who's done some outstanding things in the syndication space, in the fund space, the commercial real estate area. Just super excited. Ryan, thanks for joining us, man.
Hey, thanks for having me, man. Good to see you.
Yeah, I sincerely appreciate it. I mean, me and Ryan were talking about earlier. I heard him on a podcast maybe a year or so ago, and my wife said, you just completely stretched our thinking on what's possible in the syndication business and really how to go do it. And demystifying was the word my wife always says. She goes, oh, he made it clear. Let's go do that. So you were a big inspiration to us and super excited, man. So excited to have you. For those that don't know Ryan, let me at least give a couple of the background nuggets, and then I'll let you, really introduce yourself. But so Ryan Smith is the co-manager of multiple investment funds. So they really specialize in investing. This is really directly and indirectly mobile home parks, self-storage assets, and they represent a total ownership of about 20,000 units. So 20,000 doors or units in the self-storage area, in 25 states. They're on their 8th fund. So they raise a lot of capital and go buy a bunch of deals in one fund. So one fund represents many assets, and they've raised about $300 million in private capital and really have acquired, $700 million, roughly speaking, of commercial real estate. So Ryan, those are tremendous numbers, man. I'm excited. Well, before we talk real estate, Ryan is also, he's got an awesome background. Hopefully he talks a little bit about this too. University of Tampa, Bachelor of Science in Computer Science. He was an athlete. He was recruited for both baseball and basketball for the pros, but he got drafted as a senior in high school by the Baltimore Orioles, and then again in college by the Anaheim Angels. So he's got a tremendous, professional athlete mindset, which is just phenomenal in this business as well. But he took this route, and then also now you serve for the board of Young Life, which is Young Life College, UCF. That's a member of the advisory board for the National Christian Foundation for the Orlando chapter. So we had a little pre-conversation as well there. So I'm excited to talk about all this stuff. So let me turn it over to you. Tell us a little bit about who you are and what you do, and maybe what you're doing today, and we'll start there, brother.
Sure. Yeah, no, happy to do it. And I'm glad to be here with you, and, look forward to communicating with anybody watching this. If I could be helpful, I would love to. And feel free to refer to my introduction if you struggle with sleep. Just review my bio, and, it's not habit forming. So that's good. So with regard to your question, what would you like me to focus on? What aspect?
Tell me a little bit more about your background, who you are, what you do. I know you have a couple of children, married today, give us a little bit about, that. That's a great place to start.
Sure. Yeah, no, that's great. So married to my wife, Jamie. We're about to celebrate our 15th year of marriage here on November 5th, which I'm really excited about. We have 4 kids that are a blast, ages 2, 4, 6, and 8. They're all born. You want to know about Jamie and her administrative skills. They're all born the same week, 2 years apart, which is her.
That's some timing right there, man.
I was always popular, same, every other year, same time. I never could figure it out. Um, but but anyway, we've got two girls, two boys, and they're a joy. We live here in Orlando, and then this is where I am at this point in our office here in Orlando. So Jamie and I both come from real estate backgrounds. We come from blue collar, hardworking families. Jamie's mom, who's, my mother-in-law, is one of my favorite people in the world. She's my neighbor. We bought the house next door, and she lives there, and love her. She can wire a house for electrical today.
Yeah.
So we kind of come from blue collar backgrounds, both in real estate. Jamie had a lot of background in property management, and then I had a lot of background in more the analytics, the financial modeling side of the business. That was my role in our family's business growing up. So we kind of came together and and have built our business together side by side. So my office and her office is
still working together, literally.
Right down the hall. Yep.
Oh, that's awesome.
Yeah,
and so both of you came from a real estate family. Were you third generation? Like, were your grandparents the same? Did they buy, real estate? It sounds like your parents did, and you were kind of in the business. Grandparents, et cetera?
Yeah. I think so. What Jamie and I do today, our business is very different, very, very different.
Oh yeah. Oh yeah. We'll definitely talk about that.
Yeah. It's very different. So our family, Jamie's family, incredible people, hardworking. They would build a house from scratch, live in it for 2 years, sell it for the tax benefits, and then go do it again and again and again.
Nice.
So they weren't really, they did fine, but weren't really building anything long term. And then my family, my parents, was single family residential, buying kind of lower income housing and in the periphery of nicer areas, and then working our tails off to make it nicer. And every weekend I was trenching something or scraping something or touching something that I didn't want to be touching. Every weekend from my childhood. So and I loved it. I say that tongue in cheek. I loved it. And so both residential in nature. And so when Jamie and I, came together, I was around 23, she was 20. And we met, we instantly, or at least I instantly knew like she was it for me, and made that known to her. And so when we met, it was pretty, a quick path to a serious long-term relationship. So we started building our business while still dating. And so we started single family residential. We bought about 25 properties in our early 20s. I had capital from a software company I had started as a teenager, and we both had good credit. So we really started building for ourselves, no outside investors, no, nothing like that. And really came to the point of knowledge where once we had 25 houses, we found that it wasn't that scalable. So you think you buy 25 properties, at that point, you're really, you're in the money, and we were wrong. And at that point, we were far beyond the experience of our parents. So it wasn't like we could rely on them. So that's what
you grew up like literally a house at a time. They were doing real estate, but you managing, you doing the work, you doing a lot of the effort, and that single family experience that you saw, that's what you started applying. You just did it at a different scale than they were doing, is kind of what it sounds like.
Yeah, we did it one at a time, and we moved. Jamie and I have a habit. We have a track record just personally. When we do things, we do things. Whether it's service, whether it's we don't know half throttle. So it wasn't
go
like
all in.
It was, and it's not for bravado. It's just we do it, and it's kind of our nature. It's who we are as a couple. And so when we came together, it wasn't like we said, hey, let's do 25 houses. It was just, okay, again and better and again and better. And you get better at it. Once we had 25, we kind of hit pause, and we're like, okay, we thought by 25 that, maybe we'd have a little marginal improvement or improvement in our margin due to that scale. And that wasn't the case. So that's when we started looking for something better.
How long was it? How long was that run from maybe like the first house to the 25th house?
It was about 2 years, something
Okay.
like that.
And it
Yeah.
sounds like you did well on the capital side, which is awesome. You started a software tech company, kind of exited that, had some capital running in, but were you buying, you were still using a little leverage, like bank debt at that time, or?
Yeah, we were
Okay.
using it. Yeah.
And so the aha moment at 20, 25 houses, like you said, hey, the margins didn't scale. I couldn't quite get what you wanted. And some of those houses, I'm sure, getting older. I never got to 25 houses before I stopped, but I was about 10 before I realized I'm gonna switch over to commercial. How did you make the leap to commercial, and what was your first commercial transaction?
Yeah, no, yeah, it's a good question. What we did is we said, okay, this model, we liked the properties we owned. It was just more the model. So we still own a lot of those properties to this day, and we'll probably own them 30 years from now.
Yeah.
But what we did is we hit pause, and again, we didn't have a parent to say, hey, this is, think of this and do this.
Yeah.
So I kind of skipped this in my bio a little bit, but I had an analytics background, so I ended up doing all my dad's financial modeling as a teenager. So I had kind of an analytic background, taught myself to code and some of those things. So in my early mid-20s, what we thought we would do is build a financial model for all the different asset classes, given what we were looking for, and we wanted cash flow, capital appreciation, tax benefits, and non-correlation, or low beta, cycle resiliency. There's a lot of ways you can say the same thing. So those were the four things we wanted. And so we built a model for storage and for apartments and for industrial and office and retail and, billboards. We considered everything that we could think of. And our thought was we would put all the models on the table and let them duke it out. And we would pursue the ones that had the most merit, from an intellectually, to a degree, rigorous process. So anyway, point being is the two that kind of stood out to us for those four things that we wanted were storage and mobile home parks. And so we proceeded with mobile home parks because there were easier points of entry at the time in that space, for specific reasons.
Yeah. Cash flow, appreciation, tax benefits, and then non-correlation, which is like, if something happens in the market, it's not going to affect me, or that maybe not so correlated. Is that kind of what you meant?
Yeah.
Or is that what kind of, you're describing?
Like there's this concept of beta rating, which is, if the broader market goes up $1, does your investment go up $1? That's a 1-to-1 correlation. I want a sub-1 correlation, which means, it is less correlated. If the market goes up or down $1, maybe mine goes up and down, less than $1,
Yep.
So anyway, point being, both mobile home parks and storage are fairly low correlation.
Got it. That's okay. That's awesome. You definitely went after it in a very, like you said, analytical, scientific, like let them duke it out on paper, on the math, and kind of said, hey, before we go full bore, this is what we're gonna do. And then, what was it that led you to go, full bore? So I have heard a little bit of this on another podcast, and this is where my wife said, hey, it's just really inspiring to say, well, you were trying to figure it out and how to get there. But why don't you tell us a little bit about, like, what was next in this process? Let me let you tell your story.
Yeah, so to treetop it a little bit for the sake of your listeners, I'll give a couple high points. So we started buying mobile home parks. My grandfather is probably, my mom's dad is, from an investment standpoint, probably the greatest influence internal to our family that I have had. I've had significant external influences, but my grandfather raised us to understand how to invest to a degree. So he would give us $1,000 every year and teach us how to identify stocks. And we would always look for companies with a moat, with a competitive advantage. And so I knew in second grade what a moat was. And so when I looked at the asset classes, I saw what I thought was a moat on the mobile home park side of the business. And to make it really short, it's a simple reality that mobile home parks are needed everywhere. They're not allowed to be built anywhere because they're hated everywhere because of the stigma that they hold. And so I saw the stigma as a moat that could protect my capital. And I thought it was a durable moat, one that would be lasting. So, I thought that was a tremendous deal. And I'll make this point because I think it's important, the value of that stigma. Coke and Pepsi have spent $1 trillion in their lifespans in marketing to generate behavior in you, the listener, to their marketing, right?
Yeah.
So $1 trillion. And if I were to do a poll right now, roughly half of everybody listening to this would say, I like Pepsi, the other half Coke or something like that.
Mm-hmm.
So they're 50% effective after spending $1 trillion on the mobile. So when I was in my 20s, I looked at this, I'm like, okay, I don't have to spend a penny. And 100% of everybody agrees that mobile home parks are not something that they desire to be built near them. So which one's the more durable and effective moat? I saw a significant value lying in the streets just for whoever wanted to pick it up. So anyway, we picked it up. We built the portfolio of mobile home parks over several years. And, like anything, you take that step, you build, you never feel like it's fast enough. It's never easy. It's never as easy as you think it'll be. It's just all that, and so we're building our portfolio and things are going fine. We're by comparison, we're doing fine, but we don't take the time to compare because, for us, it's about better and how do we get, move things forward. So anyway, we had a mutual friend, Jamie and I had a friend who was much older, than us, probably 35 years our senior. He was recently the mayor of Newport Beach, and he's a dear friend to this day. But we had become friends with him, and he was watching us build our business. And he reached out to me one day, and he just said, I've watched you guys build your business, and I really want to introduce you to my good friend Brian, because I think he could be helpful to you. And I said, yeah, tell me about Brian. And I think at the time, Jamie and I may have owned something like 1,000 units or something, sweat of our brow kind of thing, our capital. And I think Brian at the time had 55,000 units that he owned and operated.
Mm-hmm. Mm-hmm.
I didn't come from wealth. I didn't even know somebody existed like that. I mean, literally, this was like a unicorn. So, Rush just said, would you like to meet him? And, my comment, if given the opportunity, I'd walk backwards from Orlando to California, to meet somebody like this. And so he goes, okay, I'll get back to you. And I think it was maybe a week or two later, he called, one night late on the East Coast. We were in Orlando, and he said, good news, bad news. Good news, Brian will meet with you. Bad news is it's tomorrow, late afternoon. And so, Jamie and I, packed our bags, got the first flight out, flew to California. We could only go to LAX. The flight was late. We had to get changed in the bathroom of LAX, hightail it down to Newport Beach, which, anybody who knows that distance, it's 40 miles, but it could be an hour to 2 hours. You don't know. And we made it by like 10 minutes, and we were sweaty, hot messes. And so we sit down, we're talking, and, we did all of this to just the chance to meet him. And, the whole dinner was fine dinner, but the whole dinner he's asking us questions, which was driving us nuts. Cause I'm like, I didn't fly across the country to about myself. I don't learn about me. That's boring. So he asked me all these questions. He's a very good question asker. But at the end, he just said, I'm really impressed with what you and your wife have done with seemingly very little help. He's like, so, I'm going to stay for the next 30 minutes, give you 30 more minutes of my time, ask any questions you have. And if I'm knowledgeable, I'll answer. That was, so, you better have questions, you better. Yeah. And I did. So I asked him, I basically, what is the structure you use? Like, don't give me the believe in yourself. I don't need the self-belief stuff. I got that. But, like tactically, strategically, specifically.
Yeah.
Like, give me the structure. So he takes the white cloth napkin and a pen and starts drawing entity structures and diagrams on the table. And at the end of the dinner, that was it. So, I couldn't fly fast enough home because I used to have this image on our website of a train where you can see 100 miles in the distance. And as I described it, and I think everybody can identify that with this a little bit, but you feel like you're on the right track, but it's as if there's fog obscuring the tracks, and you feel like you're on the right track, but you really don't have visibility, and you hope there's no cliff ahead. You don't know. But after this dinner with Brian, I felt like the fog had cleared. I could see 100 miles into the distance, and at that point, it was just execute like a son of a gun, which I'm not. That has not been my struggle historically. So we went home. We took what he had to say. We put it into practice. He was blown away, and interestingly enough, couldn't believe we did what we did with his advice. And it was the foundation for a long-term friendship. And he's a dear friend to this day.
Yeah, that is so amazing. Just on multiple different levels. I think a lot of people struggle with understanding or how the structure, like you said. I can't see the tracks in front of me, so I feel very uncomfortable picking this, train up to a speed because I don't know what's beyond that. And so it's nerve-wracking, it's worrisome, it's, there's fear behind it, all the things. But now that the fog has been cleared, it's very easy to, put more coal in the engine, right? And let's hit it hard. And like you said, I think a lot of us, many of my friends and circle and network, are very hard workers, dedicated, perseverance. They are grinders. It's just, you just never know which thing you should work at with all your heart and intensity, because you never know which one's going to, bring you the return that you want. And you're hoping that you just spent the last 5, 10, 15 years working on something that is actually going to give you that reward. And there you were with like the right vehicle, the right plan, and it's time to get after it, right?
Yep. That was a blessing.
Yeah, that's awesome. And then, the factor of, well, you guys were in it, 1,000 doors, sweat of your brow, man, kudos to you, because, a lot of people say, oh, you got lucky. Some people, hey, this guy got lucky because so-and-so met so-and-so. And yeah, well, he's, whatever the case is, they throw around the word luck. And I'm a big subscriber to that word of luck. The definition of is preparation and opportunity meet, right? You had done your hard work, you've done your effort, sweat of your brow to get 1,000 units, or mobile home parks at 1,000, to actually have the person with 50, however many say, hey, 55,000, would you like to set up this meeting? I think you would benefit from it. So you did your part. How many years did it take you to do that, to get even the first 1,000? The mobile home parks?
A couple of years. It was, I think I was probably 26, 27, probably 3-4 years.
So X number of years, 25 houses, then mobile home parks. You pulled the trigger, made it happen. And then the call comes and you have to get on the plane and, to do that, to go overnight. And you're like, man, you're there. How many people would actually, I don't know how many listeners you ask yourself, would you have actually answered that call and like gone from one side of the country to the other overnight? And you did, and it obviously had your plan, and now you get after it, right?
Yeah. So it's funny, it gives, I can brag on my wife here because she's exceptional. There's IQ people and there's EQ people, and she's Einsteinian genius on the EQ side. She's also very bright on the IQ side, but I've never seen EQ like Jamie. She's really exceptional. But to give you an example, so we did this meeting, we were grateful. This gentleman, just invested in, whether he thought it was a crumb, that was a seed for us, and we planted it and watered it and, stewarded that investment. And we did something with it. And so not only did she write him a letter, I think it was about a year later, saying, you invested a significant amount in us. We stewarded it. This is how we stewarded it. This is what we're doing. But she also found the mentor for him, a gentleman who was still alive. He was in his mid-90s. She found him as a guy named CJ Bonner. And Jamie wrote Mr. Bonner a letter saying, thank you for investing in, Brian, because your investment in him is now paying dividends to us. And then Mr. Bonner, who was Brian's, to a degree, mentor, let Brian know he had received this letter. So
such a quality engagement.
The funny part of the story, we were out in the Midwest, I think somewhere, for business, and Brian called, and just said, I got your letter, blown away, can you meet tomorrow for lunch? And we're like, no. so, so I and of course we run back to the airport, fly back out to California, meet him for lunch, and it's we've been really close ever since.
Man, that's awesome, man. Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review, and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. Just the obedience that it would take. So let me pause on the real estate for a minute, because I do want to talk about your funds. Man, that's amazing, the amount of capital and the amount of assets you've gone to create. But you're the director, or your title for Young Life and what you do there, because there was some obedience on that side, faith on your side. And it would be remiss if I didn't at least ask you about, what you're doing with Young Life, and then maybe how you saw that, over the years play out for your success.
Well, I mean, the faith component is important. I mean, I'm a Christ follower, and, and I'll say, there's really not an aspect of my life that doesn't include or pertain to. So it's easy to say, okay, here's my work side, here's my ministry side, here's my personal side, but really, the faith component, that covers everything. It should anyway. And as it pertains to, the way we go about our work, if, and I say this with respect to, potential listeners who may have other faith orientations, or, they put their faith in other places. But for me, as a Christ follower, the thing that we are to be doing for the rest of our lives is worship, and be, stand in awe of excellence. And that's, so, how that then kind of feeds into my business and kind of how we do things is we should be doing things in a manner that's glorifying, to the person who gave us so much, right? And we owe so much too for what he's done and for who he is. So to me, it should produce a product of excellence or a service of excellence. And I heard a friend of mine's wife, so a friend of mine named Tim Keller, who I love, Tim, his wife, Kathy, is brilliant. And Kathy said years ago, and I love this, but she said, excellence is the ultimate form of inclusion. And so we hear all about inclusive business and being inclusive. But, the interesting thing, think of it this way, if everybody on this, listening to this right now, if we were all walking someplace and we saw a piece of art hanging in the window that was unbelievably excellent, who would be excluded from marveling? We would all turn and look and say, that's breathtaking, that's amazing, and that's inclusive. Nobody's left out. We're all drawn to marvel. So to me, that's our challenge as I think people of faith in the workplace is, not to do things as to draw attention to ourselves, but if to do things with excellence as to cause people to ask why it was done with such regard for excellence. And the answer is, you want to see excellence. Don't look here, look there. So to me, that's a, anyway, that's all aspects of our life. So, you know,
Yeah.
we try, whether it's for profit or non for profit, you know, ministry or business.
Go all out. Uh, go all out. Well, for me, I'm a Colossians 3:23. Everything you do, go at it with all your heart. Not that you're working for man, but you're working for God. And I can clearly see like, the excellence part of your journey, man. Everything that you did, your personal career, professional athlete, you going to get at those houses, you having success in the tech side of it, then I got a plan. I know the plan. Let's go create this amazing business and acquire $700 million of commercial real estate. Let's get it on. That's awesome, man. I'm inspired by the run and your obedience to kind of follow that path, man. That's good stuff.
It's been fun. And if it wasn't for the cross, none of that matters. It could be 10 billion. Doesn't matter.
Yeah.
Yeah.
Awesome, man. Thank you very much for allowing me to ask and share. And the Young Life organization is one that, when I was younger, college, my sister served there. She asked me to come to an event. I went to their Colorado kind of, facility, or one of the ones that they use. And the first time I went snowboarding, first time I saw snow, first time I went down the mountain. And I was a skater when I was younger. So like, I loved snowboarding, and I picked it up immediately, and I was going down these, blues and the first time. Anyways, just seeing the views and then getting to talk with some of the leaders. It was very, everything was very spiritual for me, and just kind of brought me back home. As soon as I read your bio, I go, oh, Young Life. That's exactly what I remember. So that's great, man. So thank you for letting me pause a little bit and talk about that. I think it's important, whatever your faith is, whatever your background is, whoever you are, there's that calling for excellence. And I really liked it, man. If you can pursue that and you push it, excellence is the source of all inclusion, right? So we see something, we want to go, marvel at it. And that's awesome. So, okay. Transition, right? Your commercial success in funds. What is a fund? Start at the basic level, right? For a passive investor that's listening, there's a difference between investing in just one property at a time and going to do a syndication, which we're pulling our funds as individual investors. We're going to buy something bigger than what we'd have been able to buy on our own. But a fund is a different model and a different structure. So tell us about the fund. If I'm investing in it, what is it? How does it operate? And then you kind of work into, you're on fund number 8 now. So I think you have a good idea of what they are, how they operate, and how to have success in them.
Yeah, no. So yeah, it's a good question. And there's a lot of versions of funds, but the way we put together our funds, it's a many to many relationship. So it's many investors pulling their capital into an entity, an LLC, an aggregating vehicle. And then with that, we go out and we acquire multiple properties. So the goal is geographic diversification. And then we also buy both mobile home parks and storage. So you diversify across asset classes and also geographies. And so not only do you have that diversification, but because all of the properties are owned by one entity, the fund, you have a better balance sheet than if you were to do, let's say 20 properties separately versus 20 within one fund. The 20 within one fund has one balance sheet versus 20 separate balance sheets. So it gives you a lot of options that you may not otherwise have. So we've done, our first fund was 2010. It was friends and family. It was a $2 million fund. Probably the most daunting thing. And I say this with respect. You hear all the big numbers, and big things have small beginnings. And the small beginnings is where the value is. Although most people think today the big numbers are, to me, I look back and the first $2 million fund that was unbelievable. We're calling friends and family in 2010 saying, hey, yeah, great recession. I'm 29. We're going to go buy mobile home parks. We thought of you. So unbelievably, they invested with us. And I say this also with respect, the numbers, the amount raised is I understand why that's great. We celebrate when we give it back. It's nothing for it to come to you. That's the obligation. Now you got to give it back, and you got to steward it well. and do a good job. So we did our first fund in 2010, our second, third, fourth, fifth, sixth, seventh, and eighth. So we're now on fund number 8. There will probably be other funds in the future, but we're currently raising fund 8. So fund 8 will probably be open for about 2 years, so that we can have, again, enough capital to buy enough assets to build a good balance sheet, which is sometimes overlooked. The importance of that is sometimes overlooked.
Yeah, we're not buying assets just to buy an asset, to spend investor money. And you've got a bigger number, and you're trying to figure out how to, double it, or whatever the investment return is. I'm trying to make 1.5 times my money. I'm trying to make 2x my money, or whatever's out there, right? And that's important. We're trying to make a return. Now, you also have something I heard like the first time that you said this. For those that don't know, Ryan's an advisor for our mastermind that I'm in Kingdom Capitalists, and kind of Christian mastermind organization. Is really awesome. Anyways, the first time I heard you say it was, "Hey, you don't put projections or pro formas in your funds," and I was like, "What in the world? How do you not do that?" And I think about every offer I've ever had. It's like, well, this is what I'm shooting for. So, anyways, maybe talk a little bit about your mindset about return, because you're making some good returns for investors. Otherwise, you wouldn't have had this ongoing continued success. So tell us a little bit about your mindset in this, and that way, we understand it.
Yeah, I think life's ironic, and I find irony humorous. Like, for example, I'll give you an example. I was talking with a friend of mine who had a debate yesterday with a client. He's a litigator, and somebody was they were talking about truth. Of course, your normal Monday conversation. And so his friend goes, there's no one point of truth that's absolute. So I find that humorous, because that's a truth claim that's absolute, right? Yeah. So that's those kind of ironies, make me smile. So as it pertains to raising capital, investors, they generally want to invest with sound, operators that don't take unnecessary risk, yet actually have a gravity to be attracted to the sponsor, unnecessary risks in the way they raise their capital.
Yeah, that's funny. Don't lose my money. Yeah, but I'm looking for the highest return possible.
It's like, show me X, Y, Z. You really shouldn't, but show me X, Y, Z. Here's my money. Now don't ever do that again. Right? It's really funny. So what I mean by that more specifically is a lot of, well, first off, when somebody's investing into a fund or a syndication, to me, and we may disagree, not you and I, but anybody watching this, the most important, the biggest risk is the people running, making decisions. There's are they smart? Are they, educated? Are they, moral? Do they have integrity? All of those things. So to me, the greatest risk are the people. What a lot of people will do, what I've seen in the industry, is a lot of people who are starting from scratch. They may, in some cases, start up a podcast or write a book or do something to aggregate an audience. They don't feel comfortable with their experience, so they don't feel like they want the attention on them, because they don't survive the scrutiny. Mm-hmm. So what they do is they create a distraction over here. Look at my model. And so they put together a financial model in Performa, which, by the way, we use internally.
Yeah. Okay.
But the question is whether or not you're using that to market. And the problem with marketing is, what's the bias? To show a high number or a low number? A high number.
High.
The other problem is, and I think I think everybody would agree with this, there's almost a 0% probability that Performa will be met. That dollar amount in that time will probably not be met. So mm-hmm. I don't think it's a good thing to raise capital where the only decision is how wrong are you. Mm-hmm. I don't think that's good. And said in a more of an analogous way, an investment in a syndication or a fund is like boarding a ship. Okay, if you were to get on a ship and say, we have a computer running the show, it's a straight line from New York to London, it will not deviate. That's the Performa. Mm-hmm. And we'd all be nervous, because what if a hurricane came? Well, it's going straight through it, because that's what the flight plan says, or the Performa. at the end of the day, what will get the ship to its destination safely is the captain and the crew, and the ability to navigate around inclement weather based on their experience and knowledge of the vehicle. The flight plan's out the window, right?
Yeah. Yeah.
That's the best outcome for the investors. So to me, yes, have a plan, have a pro forma internally, but I don't think, one, it should be marketed to raise capital, and I also don't think that I don't think that puts the focus of risk for the investor where it ought to be. And lastly, as a sponsor, I have investors, like, a year ago is one that comes up. I had a guy from Tampa call me, and he said, I'm looking at your fund, I'm looking at investing with you, but I'm also looking at another group. But the thing about them is they have all these models, and my reply to him, and, I'm not trying to be off-putting, but it just, to me, I'm like, well, then why are we talking? Right? If they have models, why'd you call me? Because at the end of the day, models aren't everything. I just think you should put the focus on the people. And by the way, he ended up investing with us. Not that that was the right decision or the wrong decision, but
yeah.
But anyway, yeah, it's a funny, humorous thing.
Yeah, it's good. It's good to hear you, talk about it, because that's what we're trying to be conservative. We're underwriting it. You're looking at the pro forma analysis. You're looking at the market comps. You're looking at, all of the things that we do to even put an offer out on this property to make sure that it's the right deal. You're using your, entry cap rate. You're using your reversion cap rate. What am I going to sell it at? The models are there. You have them internally to make sure that it's good. It's just a difference on, hey, this is the assumption. This is the nice ride or flight or boat cruise or whatever you want from here to there with no issues, no worries, all the unforeseen things. And man, in real estate, we definitely know the unforeseen things. they definitely come about. I did this. We wrote I wrote my first ebook, right? And it was like how I invested, in my first, $93 million, and I did this passively, right? And, I kind of talk about the market, the deal, and the team. And that's the job of the passive investor. If you can nail those things down, at least the best of your understanding, that's where you want to spend the time in, to realize that, hey, man, if we're in a good market and the plan's good, well, good. Those are simple things. The team is so very crucial to having success, and forget about what the number says, because I could look at another one that says, oh, this is going to pay me an 18%, and yours only says 16. For me, I still put numbers, right? At least, it's like, hey, man, this is the deal. I mean, I wrote it pretty conservatively, and I don't want to overpromise. I want to underpromise, overdeliver. So anyways, you've taken it to a next level, and now you've got an amazing track record behind you. You can show people your track record of performance, which is also really solid, which is just awesome. Thanks a lot, Ryan, for sharing. So you're buying a ton, you continue to buy a ton, you're out there. Maybe we can spend the last couple of minutes on the show. What are you seeing from the market today? You've got, I would say, a very unique view into, what's happening today, the amount of assets that you have under management, what's occurring in many multiple different markets, asset classes. So, anything, I don't want to put a specific question on it, but just give us your take on, the current status of the market and, what we should be thinking about as a passive investor, a general partner, as we're continuing to do our business here.
Yeah, no, it's a good question. Well, I can maybe tell you what I'm curious about, what I'm interested, and this is not prescriptive, like I have an idea. It's just, I'm watching it and I'm curious. So, first I would say, just for a foundation, what we're trying to do, and I think everybody on this, that's watching this is trying to do, is they're, NOI, net operating income, is really important, because that's, number one, that feeds into what you're getting in terms of the distribution of income. It also has something to do with the value of the asset you're investing in. So net operating income growth in the long run is very important. So for us specifically, we focus on mobile home parks and self-storage, which historically over the last 20 years have had the longest, basically the best run of NOI growth for 20 years, and we think it'll continue. So we like our space, we like our asset class. With regard to the broader market, I think the next 10 years is going to be a slog. I had somebody, I talked to her yesterday, she and her husband, and she just said, well, what if the economy goes bad? To me, I'm like, we think that's going to happen. So that's actually part of, why we do what we do. But we think the next decade is going to be a pretty challenging decade for a lot of people. But the part of all of this that has me intrigued in the short run is, obviously interest rates are low and cap rates are low. We think it'll stay that way for the foreseeable future. For the last, and I one little piece here, for the last couple of years, there's been this presumption that, a cap rate, depending on the asset class, cap rates are low. I'll just say it this way in general terms, that cap rates are low. And so they're going to spring back. There's been this kind of assumption since really 2017 is when I started seeing that. And those people have been wrong now for 3 years straight. And I think they'll continue to be wrong. So what we're seeing in the short run, and one other piece before I tell you what I'm curious about, not as this is a terrible tease, but something that I think is also important for maybe your listeners to consider is, the days of high yield are really, in my opinion, gone. I think we're going to be in a very low growth, low yielding environment for a very long time. So you have a lot of people who are now earning a lot less through their job or their investments than they were maybe 2-3 years ago. And so there's a propensity for them to say, okay, I'm going to replace it. So what I'm seeing a lot of in the real estate space is there's this gravity towards higher cap rate assets for the cash flow that they provide. Many of the higher cap rate assets also come with a lot more risk. So what I'm seeing a lot of people do today is they're taking a lot more risk to produce a hopefully similar return, which on a risk adjusted basis is not the same. So for us, we focus on quality and we're not trying to take unnecessary risks. And so anyway, the part that I'm interested in, and I'll try to be succinct, historically, and this may be overly broad, but historically, you look at, let's say you buy a property today at a 5 cap. Okay. And then people will say, okay, maybe you borrow at 3. We just closed a loan last week at 2.57% on a mobile home park. So, but let's just say it's 3. So you buy a 5 cap asset and you pay 3% interest. One question people will say is, what happens if interest rates go up to 7%, and you're at a 5 cap, right? Well, you got to think of it somewhat dynamically in that, historically, in many cases, when inflation starts showing itself, interest rates rise, and if interest rates rise, cap rates rise. So the short story is that rising cap rates is inflationary. So if I can pass inflation on to my end customer, which real estate has been a good vehicle for that historically, then I should be growing my NOI significantly more. So in short, my cap rate may be higher, which means my value lower, but my NOI should be higher as a result of that inflation. So the point is, I have more of something worth less. So the value should be moderately the same or within reason. Now, historically, a lot of value has been created on the backside of this inflationary move. My partner Brian, who I described earlier, he's been a partner of ours for many years now. I told you we love working together, and I have a lot of respect for him. But he made a significant amount of money in the late 70s. He's been investing since the early 70s, and interest rates were 18%. And the reason he made a lot of money is inflation. It was so the point in all of it is, on the backside of an inflationary cycle, I say deflation in the sense of inflation moderating. So as inflation comes down, interest rates come down, cap rates come down, but the NOI doesn't come down because it's a Pavlovian response. People get used to paying a higher rate. So now you have a higher NOI with a higher multiple. So it's 2 times 2 is 4. It's a really big deal. So the part that has, I guess, today that makes me curious and interested, the Fed recently, this is no secret, they've said widely that they're going to be accommodative to low rates for the next several years, but they're also going to let inflation run, and they're going to consider it in the aggregate. So I think this creates a possibility for the potential of inflation to tick up and to run, which gives us the ability to pass that on to our customer as long as your business allows that. So we should see, if that happens, some decent growth in rental rates. But because they're also holding rates down, we then get to capitalize on that in historically low cap rates rather than higher cap rates, which has been the historical outcome. So to me, it's a potential setup for the ability to, number one, create wealth and also return wealth to investors potentially sooner than expected. Obviously not guaranteed, but I'm curious on how that'll all go.
I was on mute. Sorry. That's awesome. I think the explanation of it makes a lot of sense, where people are thinking about a bounce of cap rate. And for those passive investors that are, kind of following some of it, it's like we want, well, as a buyer, I want a highest possible cap rate as possible, with as little risk as possible. But a lot of times the higher cap means higher risk. Lower cap rate is higher price and less risk. And that's kind of how because we're buying income streams. There's property behind it, but we're buying an income stream. So with my $10 million, whatever cap rate is saying, if I had $10 million cash, I'm going to get 5% cash in return, cash on cash return of that 10 million bucks. If I buy lower at a lower cap rate, it's less return, but there's less perceived risk, and that's why they pay a little bit less. And so in this paradigm that Ryan's mentioning, it's like, man, what an amazing time right now, where you have to borrow at the just 2.57 or below 3 interest rates. And I know in my a little bit of my closer friends or family are like asking me and my wife, hey, I know you guys are going full-time real estate and really heavily, hitting it. I see all your social. Aren't you guys a bit worried that almost everything you have invested is like in real estate, one fashion or another? And I guess it's just it's a contrarian point of view, where no, I'm trying to borrow at the lowest possible rate, probably historical lows, get the spread from that and the 10-year treasury and cap rates, and capitalize right now and make the most money as possible. And then it's just hard for some people to really see from those eyes if you're not in it every single day.
Mm-hmm. Yeah, no, there's the short-term understanding of what it is you're doing, and then there's the critical point, which is far more rare, which is the persistence to do it for the long term and not deviate from the path. And that's where most people don't have it. They can't stick it out. We're geared to want short-term returns, short-term outcomes. And so it's ironic in the real estate world, just as the plane is lifting off, and the asset is really taking off, that's when most people hit the abort button and they sell.
5-year projection, and sometimes we sell in 3, and then we wonder why the deal traded again in 2 years and again in 2 years, and they're like, wow, if we would have just held it, we would have we wouldn't have had to do the work again. You did the value add the first time. And anyways, yes.
Yeah. And you pay tax on it. You pay, unless you do a 1031, which who knows, may not be available next year. We'll say the next couple of years.
Yeah.
But the point is you pay tax. So it's, for us, we want to buy quality assets, quality markets, run them like a son of a gun, hold them long-term, return capital to investors from refi proceeds, and then just continue to own them, get investors their capital, and keep the assets long run. So
yeah. What a great conversation, Ryan. I really appreciate it. I could keep you here for 2 hours, but I've probably gone over my time already, man. Let me cut it. And let me at least, if our investors, our listeners, our network, they want to reach out to you, they want to get into your world, they want to invest with you, learn more, whatever, where should they reach out to you? What's the best place for somebody interested to do so?
Yeah, sure. And if I can be helpful, if you have questions or if I can clarify anything on this podcast, let me know. But my information can be found at elevationfund.com. And then my email is ryan@elevationcg.com.
Got it. Thank you so much. Is there anything we didn't talk about today that you wanted to, highlight, bring some exposure to anything in general that you're like, man, Abel didn't ask me about this. I want to share anything in general. Take as much time.
No, you did. I thought you did a great job. I love what you do with this podcast. I think you do a great job, and your listeners are fortunate. So there's a lot more we can talk about. So if you ever want me back, be happy to do it. But no, I thought you did a great job.
All right, good deal. Thank you so much, Ryan. I really appreciate it, man. You're a brother to me in a lot of fashions, and a true advisor to me on one side. And I'm lucky to have you in my network, and I really appreciate it. And God bless you and everything you do, brother.
I appreciate you, bro.
Yeah,
that goes both ways.
Thank you. Well, I'm again your host, Abel Pacheco, for the 5 Talents podcast. If you've heard something that provided you some value today, which I believe you did, I encourage you go to our podcast, Apple Podcast, and leave a review, leave a 5-star rating. That would be amazing. If you heard something from Ryan that you really resonated with, reach out to him, leave us a note in the feedback. Written reviews are amazing. And if you have any questions about the passive investing, getting into our world as well, our website is 5tcre.com. That's 5 Talents Commercial Real Estate, 5tcre.com, and look forward to talking to you. Thanks again, Ryan. Appreciate it, brother.
You bet. Likewise.
Thank you, guys. We'll talk to you soon. Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked. Tell us your favorite guest. Give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents podcast.